Nikhil Sawhney, the Vice Chairman and MD at Triveni Turbines, to get better sense. Hi Nikhil, good morning. Thank you so much for making time and speaking with ET now. Well, good growth yet again this quarter, and it's been led by the aftermarket and export business. Do you see these segments leading the growth from here on as well?
Well, firstly, very good morning to you. Thank you for having me on. Yes, we've had a record quarter in all parameters, turnover, profitability, as well as the ending order book. We forecast, actually as a business that operates in the capital goods space, we operate through an order book. And very frankly, we are executing the orders that we had accepted last year with about a 9-month order delivery cycle. And as you can tell from our exceptional order booking in this quarter as well, and forecast for that to be, that trend of order booking to continue, we believe that, very frankly, this year is pretty much covered in terms of the growth that we may need to exhibit from FY23, but it gives us great visibility for FY25 as well. So, and it will be led by both export as well as the aftermarket, both of which are segments which are higher in terms of their contribution to the bottom line. And so we're in a good space right now.
Right now, but you're talking about how you have enough visibility for FY24 and FY25. The visibility is building up as you keep on getting orders. So you did a 46% growth, if I have it right, in FY23. Is that the run rate we should expect for FY24 and 25 as well, 45 to 50%?
Well, you know, we don't really give guidance, and so I'm a little hesitant to give you specific numbers. But suffice to say that we will continue with our track record of growth, and that at the same time as looking at preserving margins, which we've been quite consistent with in terms of saying that we'd like to maintain a PBT margin in excess of 20%, which is something that we've exhibited for the last several years. Our push right now is to really push for more growth. And Triveni Turbine is in a space right now which is extremely opportune given this energy transition that we're undergoing. As a company, we provide industrial heat and power solutions as well as renewable energy, decentralized renewable energy, steam-based solutions. And given the amount of capital that is going into the energy transition and decarbonization, specifically in the industrial space, we are benefiting from demand that is flowing through to us.
Fair enough. Let's just stress a little bit more on your overall margins, because they were limited by the subcontracting costs. By when or till when will these subcontracting costs for one contract continue? And does this imply that your margins will remain in the range of 18 to 20%?
No, like I said, our PBT margins will stay above 20%, regardless of whichever business form that we take. The reason that we decided to delineate and move a specific subcontracting cost as a specific line item of our P&L was so that it wouldn't overshadow the total raw material cost as a percentage of sales. It's very important to understand where the business sits from a perspective of competitiveness and technology, which can truly only be brought about by understanding the raw material composition and the total gross contribution and gross profit of the business. But despite that, on your question, we believe that there is substantial business as well as profitability from that current order. And we do foresee that continuing. But despite that, we do foresee not only us maintaining our profitability, but as well as enhancing it because of a higher share of aftermarket as well as export in the quarters to come.
Okay, fair enough. What about the outlook? Because your comment in the press release said that you see a noticeable improvement in domestic inquiries. Can you just be a little bit more specific, elaborate for our viewers? Which sectors is it that's leading this, and what exactly is the kind of order inflow that you're expecting for the end of the year? Any sort of target that you have in mind, maybe?
Okay. Well, as you know, we provide, like I said, solutions to industrial heat and power. And given the fact of our significant market share in the domestic Indian market, it's pretty much a duopoly between us and Siemens. We see our order book as well as inquiry book does cover the broad set of industries. And so the industries that are reflected in ordering are changed from quarter to quarter. In the previous quarter gone by, we've seen the market in India grow by about 35% in terms of domestic order placement. We don't see that continuing for the end of the year, despite the fact that our inquiry book has grown by about 56%. But we believe that the market will grow by about 25 to 30%, which is sufficient for us to take through the growth rate that we forecast. on the specific sectors, we find a demand in our current inquiry book or current order book coming from sectors such as distilleries. You have process cogeneration from the chemicals, as well as some pharmaceutical orders. You have paper. You have recycling orders from municipal solid waste incineration, as well as paper recycling. You have some plastic recycling. You have some cement waste heat recovery as well. You've in our inquiry book, and what we see a very strong demand coming from is the small non-integrated sponge iron and steel demand is something that we believe is already coming through, and distilleries may taper off a little bit given the fact of the change in government policy towards having broken rice for ethanol. But all in all, some sectors will obviously, the ordering is cyclical. And so we see that changing during the course of the year. But all in all, the Indian market is quite robust. We believe that the fixed capital formation that is taking place in the economy is quite sustainable. To just put it in perspective, the last peak that we saw in ordering in the steam turbine market below 100 megawatts was back in 2011, which was about 4,000 plus megawatts, which was ordered. And as of last year, that market was approximately 2,200 megawatts. So we still have a way to catch up, despite the fact that our economy is nearly 3 times the size as it was at that point in time. So we see the growth in fixed capital formation that is taking place to be much more sustainable in this capex cycle.
Yes, private capex is definitely picking up, and that's what we have been hearing from a lot of corporates as well. But Nikhil, just before I let you go, wanted a sense on your return on capital employed ratio as well, because that's improved to 32% in FY23 versus what we saw 23% in FY22. Just wanted to get a sense from you whether this kind of ROCE is going to be sustainable above 30%, or are you looking at expanding your capacity, so on account of that some capex etc. might come through?
Well, yes, we will have some capex, but to put the numbers in perspective, we are an extremely high return on capital business as well as return on equity. It's overshadowed a little bit when you look at book equity because of the cash that's lying on our books. So when you look at return on invested capital, our returns are upwards of 250%. So actually the business is asset light. We have asset turns in excess of 5, so that allows us to have really sweat our assets. But more than that, of course, we will be putting more capex in certain areas which are strategic to our growth, especially in the internationalization of our business. But despite that, we do not see any problem in our return metrics. It will, of course, be overshadowed by the amount of cash on hand. We did have a large buyback last year, and so therefore you saw that incrementally reflect in the growth in return on capital that you did point out. But of course, we did have higher profitability as well.
Looking at doing some other buyback or some other form of using the cash as well, because it's lying idle?
No, right now, the board has not taken any decision, so it's very difficult for us to speak about it. But suffice to say that the business is in a good space right now. We think we have a relevant solution for our customers, and which the market is only expanding as we go forward for the next several years.
All right. Thanks so much then for joining in, Nikhil, and giving us those views on how business is shaping up. So confident that PBT margins will be maintained at 20%. Enough visibility for growth, and order inflow as well looks robust. That's the view coming in from the management.